Your financial security is a sheet of thin glass. One wrong move, and it shatters. Now, ask yourself, do you actually know how the system controlling your money affects your life every single day? We're constantly told the economy is like a perfectly tuned Swiss watch. Every gear synchronized, every second accounted for. But the truth is far darker. Even the smallest friction can trigger a catastrophic chain reaction. You've seen it before. A minor tweak to banking liquidity rules triggered the worst economic collapse since the Great Depression. A seemingly insignificant shift in a foreign currency erased trillions of dollars in wealth almost overnight. But look at what's happening right now. In just the last 12 months, tariffs have been introduced, cancelled, tweaked, and dragged through the courts, only to be slammed back into place against countries refusing to give up Greenland. That's not all. We've seen direct threats to our closest allies, unprecedented attacks on the Federal Reserve Chair, and individual corporations caught in the political crossfire. Debt repayment programs people thought were dead have been resurrected. Healthcare policies were overhauled. Tens of thousands of government employees were fired, then rehired, and entire departments were shuttered. All while the national debt swelled under one of the largest tax overhauls in decades. And yet, despite this chaos, the machine keeps humming. Output is growing, unemployment is low, wages are rising, and the stock market is hovering near record highs. On the surface, it looks fine. Underneath, there's decay. A massive portion of this growth is being propped up by trillions spent on AI, data centers, and advanced semiconductors, not by the everyday spending of people like you. Even more startling, according to the BLS, total investment across the economy actually dipped in Q3. How is that possible? It's a trick of the light. While AI investments contribute roughly 2.5% to growth, that boost is being almost entirely canceled out as companies liquidate inventories they stockpiled before the tariff wars hit. Here's the kicker. From the outside, the economy looks like it's holding together, but the system is balancing on a razor's edge. And the real question is, what happens when those props are suddenly pulled away? If AI investment slows down tomorrow, the economy could collapse before your eyes, and you'd hardly notice it from the headlines. Before we look at the cracks in consumer spending, we need to address government spending and the trade balance, both of which look deceptively strong on paper. Government outlays are up because the high-profile DOE cuts have had almost zero net effect, while military spending has quietly surged. Trade, however, is where things get weird. In economic accounting, a drop in imports actually boosts GDP. Right now, data shows we are exporting more while importing less, which leads to an uncomfortable question. Are those tariffs actually working? Short answer, no. U.S. imports are down, but not because consumers are suddenly buying American. In many sectors, there simply isn't a domestic alternative. And while exports look like they're rising, you need to look at what we're shipping out. It isn't cars or tech, it's precious metals. Between October 2024 and October 2025, exports increased by $26 billion. A staggering $14 billion of that was gold alone, a 517% increase. Part of this is just price inflation, but it also reflects a global rush to diversify away from the US dollar. Even after adjusting for price, we are hemorrhaging gold to traditional safe havens like Switzerland and London. Silver exports added another $4 billion, a 2.8% year-over-year increase, with the remainder of our growth coming from military hardware and energy. So yes, the trade balance looks strong, but only because companies aren't rebuilding their inventories and the US is liquidating its precious metals. It's like a household claiming their finances have improved because they ate through their emergency food supply and sold the family car. On paper, the cash flow looks great, but this isn't growth, it's liquidation. That brings us to consumer spending. Usually, this is the bedrock of the economy. It's still driving most of our net growth today, But there are massive caveats that the mainstream media is completely ignoring. You might think the economy is booming, but most of that growth is actually coming from the richest households, not everyday people like you. And here's why that matters for your money, your spending, and your financial choices. The record growth in consumer spending is mostly fueled by the wealthy. That doesn't mean the broader population is confident or thriving. It just means the people with the biggest assets are benefiting from skyrocketing investment returns. Normally, if the system were really under stress, or even if these households expected trouble, they'd pull back. Businesses would slow, bonuses would shrink, investments might underperform. But that's not what's happening. Instead, high-income households are spending aggressively, even to the point of financial stress. That reckless spending is keeping businesses running. Factories produce, services are delivered, and the economy appears to keep growing, even though the benefits are narrowing to a wealthier, smaller segment of the population. Much of this consumer spending growth comes from healthcare and other non-durable goods, especially pharmaceuticals. Three forces are driving this. Genuine need. Americans are getting older, heavier, sicker, and less engaged with their own health. New treatments and drugs. The rapid expansion of GLP therapies has sharply increased demand. Fear. Many people worry they could lose coverage soon, creating a use-it-before-you-lose-it mentality. Layered on top is a massive web of bureaucracy and misaligned incentives. For now, all this shows up as higher consumer spending because healthcare is expensive and hard to refuse when you need it. On the surface, the economy looks red hot, but a closer look reveals that much of the growth is temporary or unavoidable, not optional. And there's an even bigger caveat. The US dollar has dropped more than 10% against most major currencies. While a weaker dollar makes exports cheaper and the stock market look like it's hitting record highs, it's largely a trick of the light. When you measure those same gains in foreign currencies, the performance looks flat, or even negative. Someone seeing a 10% rise in their investment portfolio might loosen their spending, but when an imported car or vacation suddenly costs 10% more, domestic alternatives start to look more appealing. Here's the catch. The US is the largest net importer in the world. That means a weaker dollar mainly drives higher prices for you, on top of tariffs, which research shows are overwhelmingly paid by households. One study of 25 million transactions found that foreign exporters absorbed only 4% of the added cost, leaving 96% of the burden on consumers. Imports are down because you're being priced out of the market. That isn't a healthy economy, it's a squeezed one. The truth? It's too early to call a total collapse. The American economy is huge, privileged, and tied into decades of global alliances. Shifts don't happen overnight like in smaller countries. But if other countries, investors, and customers start working around the US, the damage could take years or even decades to repair. And here's the kicker. Many of the decisions shaping this moment are being made by people who won't be around to deal with the long-term consequences. For more real stories about money, make sure to like and subscribe, because the truth is way different than what you've been told.